It's time for Wise Money with Korhorn Financial Group with certified financial planners Kevin Korhorn, Mike Bernard, and Josh Gregory.
Welcome to another episode of the Wise Money Show with Korhorn Financial Group, where every week we're helping you take your next wise step in your financial life. Thanks for being here, friends. My name is Mike Bernard. I am your host. I'm also one of the certified financial planners on the program. And with me in the KFG studios, my business partners and fellow CFPs, Kevin Korhorn and Josh Gregory.
If you have a 401k from a previous employer, what are your options with that old account? And how do you know what's best? We're going to be sharing some advanced planning considerations with old 401ks on today's episode of the Wise Money Show.
Pro tips. This isn't just like pro tips. We're like mining the depths. This is unique, but I'm going to tell you, we're dealing with a situation right now where an individual wasn't aware of some of these advanced planning issues, did something, and it caused a great strategy to not be allowed. So anyway, we're helping with that right now. If you have a question for the program, we'd love to hear from you. If you have any needs, we're here for you as well. Call or text 574-222-2000. That's 574-222-2000. Online, wisemoneyshow.com is where you can find us. Leave questions there as well. And then all over social media, wherever you're at, we are there as well. Search the Wise Money Show. Kevin, did they have a 401k at the meatpacking plant way back when?
No.
Okay.
And they didn't have the TSP in the Army.
And really?
I think I would probably be retired by now if I had an opportunity to be contributing to some of these retirement plans.
Josh, what about you? Your first job, did they have a 401k? They have a retirement plan?
No, my first job was in high school, and It was, nothing like that. No retirement plan at all.
Yeah, as a busboy, I was never offered a 401k plan. I'm assuming the restaurant didn't have it. On average, people have about 12 jobs in their lifetime. And even if, yes, say most of those or a cluster of those are in high school and college, that still is going to leave about a half dozen different careers or employers that you're going to have during your career. So odds are you're going to start a 401k, you're going to start a retirement plan, and then leave that employer and then have this decision of what do you do with it. And we want to get into some of the more complicated considerations or advanced planning strategies. But before we do, when you do leave an employer and you have an old 401k, what are your options, Josh, at a high level?
Yeah. One is just to leave it there. And it's always interesting to me that, we'll meet with clients who are in their 30s or 40s and they're on their seventh position or company that they're working for, and they may have a half a dozen retirement plans kind of left scattered around the countryside because they chose this option. And, you don't have to do anything. You can allow it to just remain there. You don't get to keep contributing to it, though, so it's going to be kind of sitting idle, invested in the ways that you choose for it to be invested, but still at the mercy of whatever those choices are. That's one option. Unfortunately, there is an option that some people will just cash it in. Mm-hmm. And they'll take their lumps, they'll pay the taxes, they'll pay the penalties, they'll essentially just wipe the slate clean and be right back to ground zero on saving for retirement. And that happens probably more than we would care to admit, right?
I think the profile for that, just if you're feeling that urge, or if you realize, oh, I don't want to do that. So, okay, what are the circumstances? If you've accumulated some consumer debt, some credit card debt, or you've got the car loan, the truck loan, and you leave an employer, I've seen that's where, like, those are the circumstances where you look and say, okay, there's 30 grand in that account. I owe 20 grand on these credit cards. Let's just start over. Mm-hmm. No, please don't.
Yeah.
Please don't. Fix the problem and stay on course.
Well, some people leave an employer because they got downsized too. It could be in the middle of a recession or something, and they'll look at that 401k as a solution to, we got to put food on the table. We got to make rent, that sort of thing. So understand why it happens, but unfortunately cashing it in and eliminating the entire account is a risk. It's an option to you. We don't recommend it, as you said. And then, rolling it over to an IRA is the most common. I don't have any statistics on that. Maybe you guys have looked that up before, but it's the vast majority of people will end up rolling it over to an IRA because you get to continue the tax sheltering that you started inside of the 401k. You don't get hit with any taxes, penalties. You continue to defer it. And when it's deferred in an account that's sheltered from taxes, investments grow faster in that time. The government's not taking a chunk of that because of growth that's happening each year. So, and then, of course, we love the IRA because it has so many investment options. You have the whole world to choose from, and you may actually be able to enhance the way you have it invested by moving it out of the 401k into an IRA.
Yeah, it's interesting when you meet with someone in their mid-50s to early 60s and you see what kind of balances they have in their 401k. And it doesn't matter what color their collar is, blue collar, white collar, any color collar. You can tell, hey, this person started investing and kept investing and didn't make any sudden moves in the shocks that happened in the 2001 and 2, in the 08, 09, and a few of these other, 2020. Mm-hmm. So the folks that did the buy and hold and continued to invest, dollar cost averaging the whole way, they have significant balances.
Yeah.
And so this is where I would encourage you, hey, do that. And because really what we're talking about, if you have it in the 401k or is it an IRA, if I could encourage you to think about anything, like what in the decision-making tree, I would encourage you to move towards simplicity in your finances.
Oh, yes.
Yeah, that's good.
Yeah. And so that is often why people choose to roll the dollars over. It's technically a transfer, a direct transfer, over to an IRA or the Roth portion of your 401k to the Roth IRA. And yeah, part of that is simplicity. And you might say, no, I have to take action there. Simple is just leaving it where it is. Yeah, okay, let's go back to, on average, you're going to have 6 employers. So you're going to have 6 of these sprinkled around the countryside that you've got to keep track of the investment balances, who the beneficiaries are, and making sure that those companies, those 401k companies don't transition to another 401k company, or the company that you worked for doesn't sell and now they've changed plans, they lose your address, blah, blah, blah. So simple is actually moving it into an IRA or 401k, and then you can consolidate any old 401ks there and manage it. Let's talk about that, like bringing synergy to your financial life. What are some other reasons why most often it's best to move the old 401k into an IRA?
Well, we believe in professional management. And the folks that have had the best results over time, most of them have a coach, an advisor, someone encouraging them to make the right decisions at every step along the way. And so we believe in professional management. You get that if you move your money into an IRA. But Mike, to your point, if you had a smaller balance, there's a couple things that can happen. One is that balance can get pushed out. I think anything under 7,000, they can push that out, or they can basically move that into an IRA.
Yeah.
And if you had that invested and you said, hey, I just got this job a year ago, I started investing, I'm investing aggressively, and then you took a different job, what would happen is they would move that money from a 401k to an IRA, and that IRA would be basically a stable value fund.
Yeah.
So you say, hey, I thought I had that money growing, and it got automatically moved on my behalf. I didn't do anything, and it's in this IRA now.
And then who's the beneficiary of that account, just in case something happens to you? And then the other one, because we hear this from time to time, that company gets bought by another investment company. And all of a sudden, you're used to seeing a statement from principal, and you no longer get a statement from principal, or you have a login to principal, and your login's no longer effective because the account's been moved to a different financial institution.
That's right. I think the point in all these examples is these are employer-sponsored plans. The employer is making some decisions on behalf of all employees, all past employees. And they may or may not be communicating those real clearly to you. You might not catch it, especially if, again, you have multiple 401ks scattered around the countryside. And so to me, moving it to an IRA is about, yes, professional advice, but you being in the driver's seat, you making the choices with your financial advisor according to your plan.
All right, we're gonna touch on, well, how do you do it? What's the process? I don't think we've ever hit that in the 10 years of doing the Wise Money Show, exactly how you would transfer your old 401k. But then get into the advanced planning strategies and advanced considerations, because some of them, even if the right option is to transfer your old 401k to an IRA, you might want to do something first or be aware of a couple things before you do that. So we've got much more coming up on the Wise Money Show with Korhorn Financial Group. Hello, YouTube. Thanks for being here. This is the Wise Money Show. What you're watching right now is our weekly 1-hour talk show that airs right here on this channel, 10 a.m. Eastern Time every Saturday morning. Also on podcasts at the same time, and also on a couple local radio stations at the same time as well, which is why there's segments and it's broken up the way that it is. But yeah, this is long form for sure. If you're looking for something shorter form, we've got that as well right here on this channel, and now over 1,600 videos. And that's a lot of content. Many of those are Next Wise Step videos, 6 minutes, 8 minutes, 10 minutes long, that air all throughout the work week right here on this channel. So make sure you hit that subscribe button, turn on notifications so you're made aware every time we drop new content. If you like the content, thank you very much. Ready.
So were you going to say, okay, so we had said leave it in the 401k, roll it to an IRA. Do we say anything about moving it to your next employer's retirement plan?
I haven't yet.
Are we going to? Or?
I mean, we can touch on that. Yeah.
I mean, the main reason is, well, if you want to touch on it, I'm happy to touch on it. I don't want to go out of order here.
Well, no, that was we sort of already passed, so we can circle back because there might be some folks listening and saying, "Wait a second, what about that?"
Yeah.
Mm-hmm. So, and then, okay, yep, I'll lead us. So, here we go. If you have an old 401k with a previous employer, what are some of the advanced considerations you need to be aware of before you make a decision on what to do with it? We are helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show is on podcast. Wherever you listen, just search the Wise Money Show. Subscribe to it there. Rate the program there as well. We appreciate it. All right, so we're talking about old 401ks, what your options are. And one that we left off was you do have a choice. If you're moving from one job directly into another, and you're immediately eligible for it or soon eligible for the 401k at the new employer, you may be able to move the old one into the new one.
Yeah, and there may be a benefit to doing that if you have, if your 401k balance is all before tax money, you've never paid any taxes on it. If you move it out into an IRA, that will affect your ability to do backdoor Roth IRAs.
Yep.
That's a different show. You can go watch that. But I was explaining, my son Caleb was a second lieutenant in the Marines, and he called me because his good buddy Ethan couldn't believe there was such a thing as a backdoor Roth IRA. And Ethan was upset that his parents had never heard about it.
Ah.
And as I explained it to him, he was arguing with me like, no, that's not possible. And
Sounds like a Marine.
I'm telling you, these guys are something else. But it is. And so, and that's not the only consideration. This is where it's very nuanced, because you say, okay, well, then that's simple. I'm just going to take my old 401k and roll it into the 401k at my new company. That might be the right answer. What if the expenses in the new plan are considerably more than if you moved it to an IRA?
Or what if the investment choices in the new plan are stinky?
Right. And what if you wanted to access some of that money for education or housing purchase? There's a bunch of things that you can access that money for that you can't really get it out of your 401k to do.
Yeah. Mm-hmm.
So
oftentimes, we already mentioned, oftentimes it is in your best interest. It makes the most sense to move the money over to an IRA or Roth IRA. Let's just camp out for just a moment. How do you do that? How do you do it? Because we were talking at a recent all advisor meeting, call it deep work, even though we don't do any deep work there. It's sorry, I'm looking at Josh. He is an advocate for a more pure approach there. But we were talking about how when when you are transferring an old 401k, oftentimes, I don't know how often, is it 50% of the time, but it's a decent amount of the time, there's some sort of snag. There's some issue. Oh, do you realize you have after-tax money in here? Do you realize you're not fully vested? Do you realize there's something there that causes some pause where you say, oh, wait, should I be doing this? And so at least for our process internally, you can many times, depending on your old 401k financial institution, you can make the transfer to an IRA online, or you can do it with a phone call. Very rarely these days is there a form that you need to print off and sign. But all of the time, we want you to do it with a Sherpa, with a guide, so that when you hit those snags, someone's right there to say, we knew that, nope, we're going forward anyway. Or we didn't know that, let's adjust and let's move that after tax to the Roth, the pre-tax money to the, oh, you didn't even have a Roth open, let's open a Roth right now, and now you're ready.
And it can be very confusing because some companies will, that money is not held in your account, it's held in an account on your behalf by a custodian. And so some companies will send it directly from one custodian to the other custodian, and you never touch the money. And people think, well, if I touch the money, I'm going to pay taxes on it. Some companies don't do it that way. They send you a check. And it's confusing because the check is made out to, for instance, the check is made out to Fidelity for the benefit of Mike Bernard IRA. So Mike gets that and calls the office and says, wait a minute, I have this check. It's made out to me. What do I do? And upon closer inspection, you realize, well, it's not really made out to me, but it's all very confusing. And if it's the first time you've ever done it, or you've only done this a couple times in your life, it's very confusing. So we have great empathy for folks, and this is why we love to serve people.
Yeah. I can't imagine trying to go through that process on your own. And I mean, there are some self-service type companies out there where you could go open an IRA on your own and then contact the old 401k and initiate the rollover. But you're exactly right, Mike. How many times do you get into the process and you realize that there is a gotcha somewhere? There's some detail that was never presented to you on your monthly or quarterly statement. You may not have thought to ask about it. And that's part of the reason why we do encourage people to either hop online and do some investigating first with their certified financial planner, or make a phone call to the company and do the same investigation. You know, your certified financial planner is there with you, taking notes, documenting all of the facts and figures to make sure that everything is going to go smoothly. It's your certified financial planner that also can be helping you decide, well, where is this money going to land? And opening the IRA, maybe this is the first time that you've ever owned an IRA. You've had all your money in an employer-sponsored plan like a 401k your entire career. Now you're going to have an IRA, and it can feel different. There's more flexibility with the IRA. There's more investment options. You're going to have more choice down the road. But with that, that can be overwhelming to a lot of investors. So opening up the bucket to receive the money is part of the process.
Yep.
It's part of it needs to be in place so that you can provide account numbers and instructions to the 401k so they know exactly where they're sending that money. If it doesn't land in your mailbox, as Kevin was saying, hopefully it will transfer electronically, but they need to have all those details up front before you even begin.
Yep. All right, let's get into some of these advanced considerations, the advanced planning issues related to an old 401k and what you do with it. And the first one is, and each of these guys could be its own show and may very well be. So we're not gonna go super deep, but more so skim the waves. First consideration, advanced consideration when you have an old 401k is, do you have some of that company stock, your old previous employer, your company stock in that old 401k? If so, you want to be aware of an advanced strategy.
Yeah. For starters, let's kind of level the playing field here a little bit and just recognize for a moment, for most people, when you have a traditional 401k, the money that is in that account has probably, for most people, has never been taxed before. It's been growing without being taxed. You didn't get taxed when you made the contributions to it. Eventually, when you start drawing off of that account, that is when the distributions will be counted as income to you, and you'll pay your tax at whatever rate your whatever tax bracket you're in. We call that ordinary income tax. Just think the normal rules, just like your paycheck would have been taxed in the past, according to the federal and state laws and everything. There is a way for you to avoid those ordinary tax brackets and instead put yourself in a position where you can pay tax at capital gains rates, which throughout history, I don't know of a time when capital gains rates haven't been the better option for people. They're lower rates and essentially could represent some tax savings. And it's through something called a net unrealized appreciation rollout, I guess would be the transaction name.
Yeah, so ordinary income, 10, 12, 22, 24%, right? Capital gains, long-term capital gains rates, if you're in the 10% tax bracket or 12% tax bracket, your capital gains rate is zero at the federal level. It'd still be taxed at the state level, but it'd be zero. So you're saving 10 or 12% there. And then if your federal tax bracket is 22% or higher, all the way up until this year, 600,000 of adjusted gross income or income, then you're paying 15% tax on your capital gains. Could be even greater tax benefit. If your income's over 600,000, then your capital gains rate is going to be 25% or 20%. And then you've got net investment income tax and so on.
State income.
Yeah. So capital gains rates, yes, are more favorable than ordinary income. There is this unique strategy if you own your old employer's company stock within your 401k, where you're allowed to change the status of that from ordinary income to capital gain. That's called net unrealized appreciation. We're going to explain that a little bit more coming up here on the Wise Money Show with Korhorn Financial Group. Josh, as soon as you started explaining it, I'm like, there's no way we're going to be able to hit anything else. This is so complicated.
I didn't even have my eye on the clock there.
I think the idea is to say, because this does not apply to a lot of people. So I think I would say if you have company stock or you're part of an ESOP, you have an opportunity to change the tax status from ordinary income to capital gains. And it's a very complicated maneuver, and this is why you should be working with a financial advisor.
All right, let's say that next.
I mean, you could put it, that puts a bow on it, and we could move on unless you want to dive deeper.
I think we can get a little bit deeper.
The fact that it doesn't apply to very many people. I mean,
well, these are all advanced strategies, so they're not going to apply to. Yeah, they're all a little bit unique. So, here we go. Third segment. If you have company stock in your old 401k, there is potentially a unique strategy that you need to be aware of and either rule in or rule out with your certified financial planner. We're helping with that right now. This is the Wise Money Show with Korhorn Financial Group. Thanks for being here. My name is Mike Bernard. With me in the KFG studios, Kevin Korhorn and Josh Gregory. Every episode of the Wise Money Show, as well as a lot of other content, is on the YouTube channel. Go to YouTube, search the Wise Money Show, subscribe to it there. Turn on notifications so you're made aware every time we drop new content like this talk show, but also Next Wise Step videos. They air all throughout the work week as well. So check out the Wise Money Show on YouTube. Talking about advanced planning strategies with your old 401k. Kevin, Josh just teased me at the break like they do when we come up with these topics. This first one, it is complicated and it doesn't impact the masses. But if it does impact you in your half dozen or so jobs or careers throughout your lifetime, you want to be aware of it, okay? So what this is if you own company stock within your 401k and that stock has appreciated. Just recently had one where the individual contributions, they had contributed about $80,000 to this company stock, and it was currently worth $1.2 million.
Wow.
That is unbelievable.
Impressive growth.
Now, think about it. If you leave that, and this person had already separated from that employer, so they were terminated, they were semi-retired. And if that person just started saying, well, and I'm leaving this old 401k in the old 401k, and I'm going to start withdrawing this money. As they draw that money out, they avoided tax on the way in, and they'll pay ordinary income tax on the way out. They start selling the stock, pay ordinary income tax on the way out. You could instead do this, what's called net unrealized appreciation, NUA. Okay, this is as deep as we're going to go for this show. You could exercise that unique strategy where you move the company stock out into a non-IRA, an individual account, a brokerage account. Mm-hmm. In doing so, you have to pay tax on that $80,000. Have to pay tax on that contribution amount, that basis.
Cost basis is the official word there. Yep.
But all that appreciation, whenever you sell the stock, would be taxed at capital gains rates instead of ordinary income tax rates.
Mm-hmm. And, depending on what the employer, who the employer was, you could continue to hold that stock indefinitely, and all the growth that happens from that day moving forward is also taxed as capital gains rates instead of ordinary income.
So this could be an enormous strategy. Now, you might look and say, yeah, I actually have company stock in my 401k. I've contributed, my basis is $200,000 and it's worth $220,000. Should I do this? Probably not, okay? But in this recent example, I was working with another advisor on our team and we were evaluating this and so on. And unfortunately, this individual hadn't worked with a certified financial planner before taking some action. 2 years ago, had started making withdrawals from this old 401k. And one of the eligibility requirements, there's 4 of them, and in order to do this net unrealized appreciation strategy, is you need to, when you start distributing money from your plan, you've got to distribute all of it within 12 months. By the way, if you have another plan with this company, if you have a 401k, but you also have a 457, or you've got to distribute all retirement plans from that company. You've got to transfer the stock. You can't sell the stock in the process. And then you need to have separated from service, be age 59 and a half, have a total disability, or doing this on account of the account owner passing. So those are the eligibility criteria. The point here, I know we went a little deep, and this doesn't apply to everyone. If you've got company stock in your 401k, run, don't walk, as Kevin says, to your CFP and start getting some help.
Yeah, exactly. And if you're interviewing a certified financial planner for the very first time, and you're talking about an old 401k, which is what the show is all about today, if they are immediately going to, hey, I have some ideas for you on an IRA that I can roll this over into, I've got a portfolio in mind already, and they're not pausing to help you truly consider these types of options, then, in their rush or in their haste to want to help you with your investments, they may cause you to make a major mistake. And we've had a number of clients over the years who they interview a certified financial planner or someone in the industry, I'll just say, maybe an investment salesperson of some sort, and they just don't have a good vibe about it. And they eventually find their way to our door, and we're talking to them about these types of things. And then they realize, oh, I didn't know it then, but I realized that I was getting advice from someone who wasn't pausing to consider the entire field. They didn't even describe to me the minefield that we're going to be walking through here. And, to me, it is about a comprehensive approach to financial planning.
Yep. Don't
just be in such a hurry to change your investment game plan. Pay attention to the tax picture and your overall retirement plan when making these choices.
Yeah, I mean, you're making me think, and this is a little bit of a divergence from the agenda, but if you don't have a certified financial planner who's also helping you with your tax planning and either connecting you to your accountant who is doing tax planning and they're talking together, or they do it in the house. At KFG, we're vertically integrated. We do it in-house. Because the worst time to find out, hey, you did the wrong thing, is when you're sitting with an advisor. Because one time, we had a new person who was considering becoming a client call in, get a meeting scheduled, and then they wanted to prepare for the meeting. So in preparation for the meeting, they went in their 401k and sold their company stock. Oh. And they said, well, if the company stock, I want to take less risk. If the company stock is in the fixed account, then it would be better, and we can just kind of start fresh and make some decisions. And the problem is you can rebuy the exact same amount of company stock. You just changed your basis completely. Yeah. So that's the kind of the worst time. Just like right now, the worst time to find out you converted too much money from your IRA to your Roth IRA is when you sit down and look at your tax return and realize the advanced premium tax credit is taken away and you owe.
Yep. So net unrealized appreciation, we're going to talk more about that strategy, future shows and all that, but if it potentially applies, work with your CFP. Second advanced planning strategy with your old 401k is if you leave that employer when you're 55 or older. Now, we're going to explain what this is. Oftentimes with 401k plans, your plan needs to adopt certain features. This is not an adopt a feature. This is part of the 401k tax code. I don't know what line, I don't know, but all plans have this. That if you leave your employer after you turn age 55, if you make withdrawals from that plan, yes, you have to pay tax, but there's no 10% tax penalty, early withdrawal penalty, like there would be on IRAs or other accounts because you're not yet 59 and a half. For your 401k, that rule changes to 55. Here's a couple catches, though. Technically, it's the year in which you turn 55, even if you leave your employment at age 54. But if you're turning 55 that year. But the other gotcha, and Josh, you might have more. I can see you're chomping at the bit. Oftentimes people say, well, I left when I was 54, so I'll just wait until 55, and then I'll start drawing the money out. No. You have to terminate with that employer in the year you turn age 55 or after.
Okay, and I wanted to go back to something that you said and make sure that my understanding is matching what you're saying as well. Because I would have framed it as the IRS says that these 401ks are allowed to have a rule at age 55 if you retire from the employer, if you leave at that age. But the employer does have to write the plan document to be in compliance with that. And we've just seen over the years some plans where the IRS gives the flexibility, but for whatever reason, they may have written it to not give you this option. And so before you just rush out and give your notice that you're going to retire at age 55 or anything, make sure that with your plan that this little nuanced rule is reflected in the plan document. The plan document is like the rule book for the retirement plan. And you want to just make sure that if the IRS says it's available, your employer wrote their plan to also match it.
The unique thing with this, unlike the net unrealized appreciation, is if you're looking at early retirement and you think, well, I might need to draw some of this money out before age 59 and a half, that doesn't mean that it's all or nothing, that you would need to leave all of your 401k there. You can just leave a portion of your 401k there and then roll the rest of the dollars into the IRA and just leave the portion of the 401k that you'd want to access before turning age 59 and a half. So, all right, we've got more coming up here on the Wise Money Show with Korhorn Financial Group. Okay, my favorite show on TV is the OG podcast that was a TV show, and it's Pardon the Interruption on ESPN, where I can't remember the guys' names.
Stephen A. Smith.
No, not Stephen A. Smith. I struggle. I don't get along with him. But at the end of each show, they do corrections. I think there might be a correction here, at least from Corey, because Corey yesterday said, Rule of 55 is part of an IRS code and does not need to be inside of a plan document. I thought it used to be as well, which is why I asked him. I think their rule might have changed, and now plans need to be restated and all that stuff, and it's just automatically part of it. So, work with your CFP, work with your...
Yeah, for sure, because the challenging thing is the rules change all the time.
Yeah.
But what I'm seeing is the rule of 55 withdrawals are not automatically allowed. It depends on your 401k plan's specific rules, and here's what you need to check. Your employer's 401k plan rules. Not all 401k plans allow partial withdrawals after separation.
Oh.
Some plans may require you to take a lump sum distribution instead. Others, force you to roll it over to an IRA, which would eliminate Rule of 55 eligibility. So check your plan with your plan administrator.
And that would always be the safe thing, because we're going to talk about the 401k loan stuff. And even before the show, we said that's just not consistent, even with what's written as, hey, this is how it's supposed to work.
And the confusing thing is, can I leave my job at 53 and then take the money out at 55?
No.
I can't.
No.
Right. And so,
all right. So we've got 3 more, and they're all quickies. So it's the last segment, but we don't need to rush through it.
This is the last segment.
This is the last segment. Yeah. We don't need to rush through it, but I would like to at least honorable mention all 3. So the vesting one's going to be very quick. The 401k loan could be a little bit longer. The age 73 one could be really quick as well. So, all right, here we go. Thanks for being here. This is the Wise Money Show with Korhorn Financial Group. My name is Mike Bernard. With me in the KF2 studios, Kevin Korhorn and Josh Gregory. Stay up to date on all Wise Money content. Find us online, wisemoneyshow.com, and then all over social media, wherever you're at, you can connect with us that way as well. Search the Wise Money Show. Talking about advanced planning strategies or considerations when you have an old 401k. If you have company stock in that old 401k, don't walk to your CFP and make sure they're a CFP, make sure they do comprehensive planning, and they can talk through your options with you on whether you'd want to consider a net unrealized appreciation strategy. Second, if you're considering early retirement and leaving your employer in the year you turn age 55 or after, there is mixed messages. There are different, depending on where you go, there's different rules or explanations of the rules. Work with your CFP, go through your plan document, talk through your 401k with your 401k advisor, and explore whether you can avoid the 10% penalty by leaving the dollars in the 401k. Next 3 advanced planning strategies are a little bit quicker. This first one is if you leave your employer and you're not fully vested. You're not fully vested. Let's just explain what that means really quick.
Yeah, vesting is basically a rule that applies to contributions that the employer made to your account for you. So there might be a match, or there might be a profit-sharing contribution, that sort of thing. And a lot of employers will attach to these dollars, there's some strings attached in the form of, hey, we want you to stay. This retirement plan is an incentive. It's an employee benefit. We want you to stick around for the long haul. But if you leave in the short term, you may forfeit some of the employer match dollars. Now, don't hear me say that the money you've been contributing out of your paycheck is in jeopardy. That money is always yours. It goes with you. You control that when you leave your employer. You can, take it with you. You can cash it in, whatever. All the different options that we talked about earlier in this show. But if you are on the brink of being fully vested or whatever, some professions, it's common for an employee to leave the employer and then maybe come back and gain some additional vesting time down the road. Maybe not. You might be leaving for good. You didn't part ways well, let's say. I don't know. But if there's a chance that maybe you could keep more of those employer dollars by returning to that employer down the road, that's something to keep in mind, and not to just rush right out and move the money.
It is.
Don't do it. Don't do it. My mom worked for AT&T for 9 years. She needed to work for 10 years to get the pension. She never did.
No.
Yeah.
And she talked about it until she died. Like, I just gotta go back and do one more year. I'll go be vested and I'll get the pension.
It is pensions, though, more commonly than 401k dollars,
Right.
where people, the vesting schedule is longer. And a lot of teachers, for example, might leave one school system and go to another, and they can be accruing, vested years in that other school system. So just keep that in mind.
The common question is, you're sitting down with a new client, or maybe you have this as well. You're looking at your 401k. The big number says 20 grand, but below that in finer print, it says vested balance 18,000. And you're emotionally connected to 20 grand. and folks look at the financial planner with this desperation, like, what should I do? What can I do? How do I get the 20 grand? Do I wait? the only way is to go back to work there. And if you're not going back to work there, then there isn't anything you can do to uncover that unvested balance.
Or have the conversation with the certified financial planner before you choose to leave, right?
Yeah, right.
Because, again, that's like a major life decision. That fully goes in the category of things to talk about with your certified financial planner. If you're thinking about changing employment, just think through all of the ramifications with your certified financial planner ahead of time.
Yeah. And Josh, especially today, is the most equipped to talk about vesting. But because there are three.
Wow.
There are.
We don't have time for dad jokes, Kevin.
Yeah.
We got
Our
to.
radio listeners don't know I'm wearing a vest.
Okay.
But there you have it.
So I mean, there's either immediate vesting where you get it all. There's a cliff vesting where after 2 years, then you're fully vested. You're 0% up, and then after 2 years, you're fully. Or graded vesting where after the first year, you start getting 20% a year.
Fourth advanced planning consideration when you have an old 401k is if you have an old 401k loan inside that 401k. These rules changed recently, and this one feels it's logical, but man, it just hurts your feelings. Mm-hmm. If you leave that employer and you have a 401k loan, can you pay it back? Yes, within a certain window. The rules are not consistent. It used to be you had 90 days. Now, the IRS, the rule, part of the Tax Cut and Jobs Act, is you have up until your tax filing deadline, including extensions. Mm-hmm. So if you leave your employer in May, you have until the following October 15 to pay that thing back. Some allow you to just write a check. Some even allow you to withhold it from your new employer's paycheck. Like, there are no consistent and clear rules with this. But be aware, if you just sort of ignore, and you're not aware of that, and you think, I've got this loan, but no biggie, I'm just blinders on, I'm rolling my old 401k into my new 401k, or my old 401k into the IRA, bam, you lost your ability to repay that thing, and it's going to be taxable to you, potentially penalized as well.
That's right. If you don't pay back the full loan amount, then it's considered a default, and that is treated as a distribution. It's as if you had gone into the 401k and pulled some money out, and if you're under age 59 and a half or whatever the rules are for your plan, you may also not only pay tax on that defaulted loan, but also pay a penalty, 10% penalty.
I think even there might be some rules now, and I'm just thinking about this, where even after you roll the 401k over, you can add the money back to your IRA. These rules are changing, and it is very, very obscure. And so work with your CFP. If you're leaving and you have an old 401k, they'll dig through all the exceptions and the rules and figure out the right game plan and approach for you.
Yeah, they're applied differently. So this is where it's very confusing. I would tell you, if you have a 401k loan, before you leave the company, find a way to get it paid off, and just do not leave the company with a 401k loan.
Yeah,
and use a different credit facility to get the money you need.
Because it's not just the tax that you'd have to pay. If you're not 59 and a half, then you're having to pay the 10% penalty. So, I mean, you think about that compared to other loan rates, right? You know, the tax plus the penalty and what that cost is, it hurts. All right. And then the fifth advanced strategy, pro tip, advanced consideration that you need to be aware of with an old 401k is if you've had an old 401k. Meaning you left the company a long time ago and you had made that decision. Josh, when we talked about it at the beginning, what are your choices? You made the decision, I'm just leaving it there. I'm not going to do anything with it. I'm moving on, and maybe I'll keep an eye on it, whatever. But now you are past your required beginning date, also known as you're now forced to take your required minimum distribution. 401k rules are very unique when it comes to required minimum distributions. For IRAs, you can aggregate, you can tally up all of your IRAs if you have multiple, and take your RMD from just one, from just two, spread evenly. It doesn't matter. All of your IRAs are aggregated. Your 401k is not aggregated with your IRA. It's separate. Mm-hmm. And if you have multiple 401ks, those are not aggregated. Those are all separate. Okay? And then you say, oh, I didn't realize that. I want to change that. Let me move my 401k over to an IRA. As soon as you do that after turning age 53, they force you to take the RMD immediately, and then you can roll it over. So it's now even more complicated rolling over that 401k after age 73.
Mm-hmm. I wondered if you were going to also highlight the fact that when you take distributions in retirement, if you're taking them from a 401k, you also just don't have the kind of flexibility on how much to withhold for taxes. That 401k will require you to withhold 20% for federal taxes, whether that's the right amount or not.
Yeah.
And this is one of the primary things that we love about an IRA when you get to retirement and it's time to start taking required minimum distributions. First of all, it's easier, as you said, you've got more flexibility on which bucket you pull it from, but you also have more flexibility on how you handle your tax withholdings.
Yep.
And that is crucial because when you get into retirement, yes, tax planning is a big part of your distribution planning.
Odds are, whether it's throughout your career because you're average and you have a few employers, or at retirement, you're going to have a decision. What do I do with my old 401k? And the point with all of this, yes, is to cast some light, share some of these unique considerations, but also work with your CFP. Have it not be a rush. Have it not be a surprise. Work with your CFP on that. That's all the time we have for today. On behalf of Josh Gregory, Kevin Korhorn, all of us at KFG, have a great weekend. We'll see you next Saturday for the Wise Money Show with Korhorn Financial Group.
Securities offered through Silver Oak Securities, member FINRA/SIPC. Advisory services offered through KFG Wealth Management, LLC. Doing business as Korhorn Financial Group. KFG Wealth Management, LLC and Silver Oak Securities Incorporated companies are unaffiliated.